11 regional banks may fail. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, 11 regional banks just had their ratings downgraded. We're going to talk about why they had their ratings downgraded and why these banks could be the next to fail. And we also have hedge funds now making one of the biggest bets in history against the markets. We'll talk about why we think they're completely wrong. And is the U.S. economy headed into a recession? Well, this one report says not even close. Now, we also have a special announcement. On Wednesday, we have a sponsor lined up for the show that's going to be very different from all the sponsors you've seen in the past. We've been working very closely with the management team of this company and what their motivation is to coordinate the timing of their sponsorship. So look forward to Wednesday for something you're going to see is very different than we've had in the past. Let's head over to the Wall Street Journal, where we picked today's story up with a headline: Moody's downgrades 11 regional banks, including Zions, U.S. Bank, and Western Alliance. And this is almost too little too late, but it's really good, the fact that they're doing this, because consumers, depositors, investors, we need to know where these risks are at with our money, and it's about time that these rating agencies get around to this. Now, I know in the past you saw during the global financial crisis, the rating agencies were almost helping, and you've seen it in the movies, in the books, what they were doing to actually support what was going on. So I want to know what you think. Is this too little too late by the rating agencies, or do you think they just didn't see what was coming? Let's take a deeper look at who they see are at risk. The downgrades hit lenders including U.S. Bank Corp with some $682 billion in assets, Zion Bank Corp with $89 billion, and Bank of Hawaii with $24 billion. Western Alliance Bank Corp, one of the banks hardest hit by regional banking turmoil, received a 2-notch downgrade, while First Republic, which faced a run last month, has preferred stock rating cut. But it doesn't stop there. The rating agency said strains in the way banks are managing their assets and liabilities are becoming increasingly evident and are pressuring profitability. Recent events have called into question whether some banks assume high stability of deposits and their operational nature should be reevaluated. And this is, an issue we've discussed on the show, that, deposits historically stay on bank balance sheet for an average of around 5 years. Now, it could be a little shorter, and depending on the type of deposit, whether it's a retail or a commercial deposit, may actually stay a little longer. But the notion is banks assume that even though these deposits can leave in an instant, as we've seen recently, that they're actually not going to go anywhere. So it's kind of odd that the rating agency makes a statement. Let's go back and look at this, and says assumed high stability of deposits. Well, we can go back and look at reports from the U.S. Treasury, who has gathered data for decades on the banking industry, and said, yes, this is exactly what you should expect. The only question then becomes is, will we see something in the future that gives the government or the banks or some policymakers the ability during bank runs to lock down deposits? I think that could come. I'd love to know what you think. As regional banks, Moody's said, are more exposed to hard-hit commercial real estate, this is something I think is going to be a big deal at some point later this year, as U.S. banks now hold about half of total commercial real estate debt outstanding, and some are concentrated in construction, office, or land development. And when you get a slowdown in the economy, those are going to be hit. Well, I think we're going to see, of course, the next story for these banks. Is it going to be deposit flight? It's going to be the risk they're holding in commercial real estate. Let's see what other banks at Moody's flags here. The downgraded banks are Associated Bank Corp, Comerica, First Hawaiian, Intrust Financial, Washington Federal, and UMB Financial. These are all now facing have had ratings downgraded and could be on the list of one of the next 11 banks that we see fail. But what do you think? Do you think we're past this? Do you think this is all over? Do you think the Fed and the other policymakers saved the banks, or are we just in the calm of the storm and something much worse is to come? Now let's head over where we talk about what's going on with Credit Suisse. Right before they failed, we covered that there was a big move, of course, in the central bank liquidity backstops. Everybody was in denial, saying that no, that wasn't them, and now we're starting to see that it was. As Credit Suisse saw $69 billion of outflows before the UBS takeover, so it's also taking a 1.3 billion franc impairment and saw 47 billion in franc of outflows in its wealth management decision as money went flying out. And the Swiss bank lost more than 200 billion francs of customer deposits over a 6-month period, culminating in several frantic days in March before the government orchestrated sale. First quarter results on Monday showed as key units continue to lose money and shed clients. And if you remember, they said, no, that wasn't happening. And we said, hey, you know what? We think that it still is. And sure enough, what did we find out? The firm borrowed far more from the central bank liquidity backstop than previously known, because if you could imagine, if the word would have gotten out in the middle of this deposit flight that it was worse than they were saying, that bank probably wouldn't have made it through to the sale. And that's how bad it is, and that's how fast technology and money is now moving today, and the banking system and regulators just aren't able to respond to it. At the end of the first quarter, Credit Suisse's borrowings from the Swiss National Bank totaled a whopping 108 billion francs after it repaid 60 billion francs in borrowing to support its liquidity levels. It raised another 10 billion francs in April after the quarter closed, just going to show that the stress that banks saw in such a short period of time was just catastrophic. And of course, as we now look back to that Moody's article, those 11 banks, and we kind of now have to wonder if they saw another big round of deposit flights, how many of them have the ability to stay in solvency? Can the government react fast enough? We just don't know. But the hedge funds now, we're seeing have placed a huge bet, one of the biggest bets in history, against a certain sector of the economy and the market. And we're going to suggest that why they've got this completely wrong and are on the wrong side of the trade. But let's take a look at what they're seeing here. As hedge funds place the biggest ever short on benchmark treasuries as they look to see inflation continue to rise, and leverage investors boosted their net shorts on 10-year treasury futures to a record 1.29 million contracts as of April 18th. It was the fifth straight week that net shorts had increased, and what we're seeing here is potentially opportunity knocking in the bond market. We'll get into this in a little more, but let's see what they're up to, as hedge funds may be thinking that inflation will be stickier than many in the market are currently expecting. On the face of it, this big short doesn't reflect the view that there will be a near-term recession. So what we're seeing from the hedge funds here is these massive bets that rates are going to rise, the Fed's going to further pull rates up, inflation is going to stay high. But is that likely? Well, let's first take a look at what the federal funds rate is, and then let's take a look at what the yield curve is saying, because what they're both telling us is perhaps these hedge funds are on the wrong side of the trade, which gives investors who are long bonds a huge opportunity. Here we can see in this chart the market yield on U.S. Treasury securities, the 10-year Treasury securities against the federal funds rate, that's shown in red. And what I want to point out on this chart, you see the yellow marks where the blue line, that's 10-year Treasury yields, often lead the federal funds rate down. So you notice here the Fed funds rate is still rising and 10-year Treasury yields are just starting to fall. Here you can see they're starting to fall as, again, the Fed is still raising rates here in the early 2000s. We see that again going into the global financial crisis, rates are starting to fall. And all that's what we know is the bond market telling the Fed that, hey, they've got this wrong. Let's continue and see whether there's some other points here. As we know, going into the head of the pandemic, before the Fed cut rates, 10-year Treasury yields were falling. We see them again now. So what we're seeing, at least from the onset here, is that hedge funds believe that the bond market's got it wrong and they need to take these big bets that rates are going to rise. If they're wrong and rates fall, well, it's going to be a bloodbath in their portfolio. And let's just see what the probabilities of that is. Here we have the market yield on U.S. Treasury securities, again, the 10-year, now against the 10-year, 2-year yield curve. And what we can note is I marked spots here in yellow where you see it's inverted. And notably, I kind of marked roughly corresponding peaks or parts of the 10-year bond yield where we see yields start to fall after an inversion. Here we can see, again, the bear steepening or bull steepening in the yield curve. And what do we see? 10-year yields fall. Here we see them falling again. Here we see an inversion. Then following here we see an inversion, and now we're in the beginning stages of what looks like a bull steepener, and yields are coming down, which suggests, as we've shown in the past means that inflation is also likely to come down. Of course, the hedge funds don't believe that, but let me give you another look at this chart here. Now let's invert that yield curve, now still shown in red, but inverted. So you can see when the yield curve inverts and rolls over, yields fall, inverts and rolls over, yields, the blue line falls. We see that happening every time. Now we're seeing the beginning stages of that bull steepener in the yield curve. And of course, if there's one way you can keep track of that, that's that CTA-Timer CTA-Timer Pro. We've been talking about that for months now. It's in the links below. It's $30, going to 40 soon. It gives you a lead of when things are going to move so you can get on it quick. So check that out. There's videos there available as well. Let's continue on and see what the hedge funds had to say about this. Because the group has a checkered track record in treasuries as yields declined in 2019 after the previous record short. When leveraged longs hit a multi-year high in 2021, yields did move modestly lower soon after before surging as the Fed headed toward a rate hike. And here you can see just how poor this is as a timing indicator. Here you can see the short position in these vertical dashed lines, and here you can see this massive short position back in 2018, 2019, and what happened here. You see this black line, that's 10-year treasury yields. They were falling, meaning these hedge funds were taking a loss. And as they cut their shorts, look at what that did. That accelerated yields moving to the downside. And of course, that's what the bond market would be looking for. So if you see these big bets that yields are going to rise and you're seeing a trend of lower yields, what it suggests is, again, that bond prices perhaps are more likely to rise, particularly if these hedge funds pull off these shorts. But what is the motivation behind them? Well, this is what one expert says. There may be another explanation for the moves, as short positions could be exaggerated by a revival of the so-called basis trade, when hedge funds buy cash treasuries and short the underlying futures. The trade involves buying bonds that have become cheap relative to the underlying futures and then selling the futures to pocket the difference. The profit is usually small, hence the tendency to use leverage. But in a world of huge deficits and no more QE, leveraged funds have a lot more opportunity to reap profits by buying cash bonds and selling the underlying futures where the arbitrage opportunity exists. So what could happen if they do start pulling off those shorts at some point, what you could see is a big rally in bonds. Again, our CTA-Timer Pro is a great report at catching these big outside moves. Check that out. So now the question we have to ask is the economy headed into a recession? Well, a lot of data is pointing that way, but one government report says nowhere close, not a chance. Today we had the Chicago Fed National Activity Index, which points to, as the government's now saying, steady economic growth in March, as the index was unchanged at minus 0.19 in March. Now, if you think, hey, wait a minute, minus 0.19, that must be bad. Well, according to the Chicago Fed Index, it has to be under minus 0.7 before it's actually a problem. So at minus 0.19, no big deal, they say. 3 of the 4 broad categories of indicators used to construct the index made negative contributions in March, and 2 categories deteriorated from February. The moving average, the 3-month moving average, increased to 0.01 in March from 0.09 in February, again indicating that virtually nothing much in this report suggests that anything's a problem, even though we're seeing a broad-based slowdown. Production-related indicators contributed minus 0.8 to the report, down from plus 0.04 in February. Manufacturing production increased. The contribution sales, orders, and inventory to the report moved up to minus 0.02, so an improvement there. But get this, employment-related indicators contributed plus 0.01 to the report, up from minus 0.09, suggesting almost no change in unemployment status. So we kind of know that looking ahead to the payroll report here in another week, to suggest that perhaps things aren't all that great in the labor market in terms of adding new jobs. But zooming out on looking at the Chicago Fed National Activity Index, well, we circled some points here where we see recessions. You can see the blue line heading down, and right now it's just kind of heading flat across the horizon. Again, according to the government, it means there's no recession here, at least not coming in the near-term future, although I think we might disagree with that. But what matters right now as we head into next month, the Fed's got a meeting on May 2nd and 3rd, and of course, if they're looking at this data, it means a hike could be in the cards. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.